All right. Hello and good afternoon, everybody. The time is now 2 p.m. Eastern, 11 a.m. Pacific. I want to thank everybody for joining in today's TMC Connect web broadcast entitled Paycheck Protection Program Loan Advances, Best Practices in Accounting Considerations. Today's session is brought to us largely based on the feedback that we've been receiving from within our network. Seems like a lot of organizations looking to seek guidance kind of across the board on the PPP program. So we're really fortunate enough to have a great subject matter expert and TMC preferred partner with us to guide today's discussion. We have Mark Wilson with us from CWDL, as many of you know, our mortgage banking CPAs within the network. So Mark, if you would go ahead and advance the slide for me. So just want to remind our attendees, go ahead and check out TMC Connect as well as our TMC member event calendar, both of which are available for viewing on the Mortgage Collaborative's website. It'll keep you up to date on the upcoming TMC Connect broadcast. And I encourage you to keep checking in as we're going to continue to fill in new great sessions based on the feedback we continue to receive from our partners and our members. So before we jump into today's discussion, just a couple rules of engagement for the call. First off, whether you've dialed in or you're connected via your computer, all lines have been muted for today's discussion. And that's done only to avoid any background noise in your area and to ensure that all attendees can hear today's presentation clearly. Now, we want these discussions to be as interactive as possible. So I encourage our attendees, please feel free to submit your questions throughout the discussion, and I'll go ahead and verbalize those to Mark on your behalf. How do you submit those questions? Well, you can do so via either the chat or the Q&A functions, both of which are accessible at the bottom of your Zoom screen menu. And you can type those questions in throughout the discussion. I'll see those on my end and be able to verbalize those to Mark throughout the portion of today's call. Today's call also will be recorded and will be available for playback. So instructions to access a copy of the recording as well as a copy of the presentation deck will be distributed to all attendees in a follow-up email that you should receive tomorrow. And if you advance one more slide for me. So jumping right into it, as I mentioned, leading today's discussion is managing partner of CWDL, Mark Wilson. Hey, Mark.
Hey, how's it going? Thanks for having us today.
Going great.
Good.
I appreciate you joining early on the West Coast.
Yes.
And then also on the line from CWDL, providing moral support, any necessary follow-up for our attendees for today's discussion, is Director of Business Development, Casey English. Hi, Casey.
Hey, guys. Thanks for having us.
Absolutely. Well, really grateful to both of you for taking the time out of your busy schedules to help lead today's discussion for the benefit of our members at TMC. So on that note, let's jump right into it. And I'm going to go ahead and turn it over to Mark. Mark, the floor is yours.
Great. Thank you very much. Like I said, I'm really happy to be part of the call and kind of help navigate through this. We had big plans this year to get real involved with TMC, and of course we've been some limited exposure being able to meet some of you at the conferences. So hopefully it's a little bit of our opportunity to introduce you to our firm, but more importantly, help provide some really some meaningful, valuable information about the PPP loan itself and the forgiveness portion of it, as well as a couple other things we're going to touch on today. Of course, our legal department always wants you to know that we are just giving you a kind of an overview of how this works. Please, once you engage with your professionals, they're going to have the ultimate authority as you get some additional advice. Real quick about our firm. We are absolutely dedicated to space. We have lots of clients all over the country. We do all kinds of services related to this industry, and we're deeply involved with it, and we're happy to be a part of it. In that goal, we try to make sure that we're driving value and providing lots of free information. We've been involved with the CARES Act and PPP, and we've done multiple webinars around that, trying to make sure that our clients are really informed We have that entrepreneurial mindset and kind of think outside the box. So hopefully we're fulfilling that role with you all today. And not to make it a big commercial, I won't spend more than 10 more seconds on this, but the services we provide are tax planning and support, multi-state, all over the country. We do your traditional audited financial services, specifically for the mortgage industry, satisfying all the different regulators and GSEs and alike. Some of the things we do a little unusual is we can serve as your accounting outsource company, so we can fill in from CFO down to accounts payable. We are experts in A&B and loan vision and all in QuickBooks as well, and all those other related back-end LOS systems. We do A&B implementations and loan vision implementations. So a little bit different type of firm in that we try to make sure we complete the full circle and what services you need. And we want to be that support for you. So that's enough about us, and let's jump into the PPP update. I think as some of you may know, there is some additional guidance. First, the application for forgiveness was released sometime last week, and then on Friday they provided some additional guidance. They had some pretty good FAQs that they released. So we'll dig into that part a little bit later on this call. But what I really want to touch on in the front parts, why I still have your attention, are some of the critical things that we think mortgage bankers should be considering. And that's the accounting entries as it relates to this particular entry. So we'll go through some of the blocking and tackling on, what we are recommending, how you book this transaction. Then we're going to talk a little bit about the tax considerations. So how is this being treated? There's been some noise out there, some conflicting things, and we'll go through that. Then we'll go through the forgiveness rules and the new guidance that have come out. And then we have a worksheet tool that if you want, we can send that off to you. This slide will be provided for you at the, like Tom said, later, which has all these resources for you to take a look at. So let's jump into kind of the actual accounting treatment. As mortgage bankers, we know that we're concerned a little bit about net worth and how that gets treated, and then also how it relates to this particular loan that most people, I'm assuming on this call, have received. That's why you're on this call. So going through the transactions might help kind of figure this out. So I'm going to walk you through it real quick. Obviously, as the loan was funded, you got approved, the loan came in, you put that money in the bank, you have cash, and then you had a liability. The idea here and best practices is you really want to segregate that money as much as you can. We want to make that easy to what we call audit proof it, or at least be able to review it. So when you submit your application and support to your bank, it's easy to follow. So we feel like that's an important piece, but making sure that the accounting is clean in the beginning. What's going to happen is, and most of you have probably already done this, you probably have already had payroll run, maybe 2 or 3 at this point. We're kind of into the game. Most people have already been kind of down the road on this. You're going to expense your payroll. The money is going to be, you're going to pay the payroll. It's going to come out of your bank account. So you're going to, debit your expense or your liability, and you're going to pay it with the cash. Pretty straightforward. Nothing unusual there. But the next part of this is a recommendation. This is a little bit out of, when I say some of our core values is trying to think about this from our client's perspective, is because of the principle of matching, we want to match expenses to income in the period that they're earned. We are recommending that you create an asset on your account for the PPP loan forgiveness receivable for the portion that you can reasonably estimate will be forgiven as you're paying it out. And then on the other side of that, you're going to have a cancellation of debt income. So this is one area where some of our clients, and we had a call with them that we're trying to understand this entry a little bit more. But really what we're doing is matching the forgiveness amount to the period where you're actually earning that based on the guidance that are clearly stated in the code, which constantly are being updated. So this is a way to make your balance sheet neutral. So if you didn't do this, you're going to have a payroll expense, you're going to pay down your asset, but your liability stays the same. So kind of the unintended consequence of this is if you're not doing the entry that way, you could be pushing your ratios in some of the situations that you're in. So when you file your compliance certificates, that might be something that pops up. So you want to take a look at that. Obviously, overall, as you don't have to pay back this loan, you know, the cash flow portion of that is nice, but we want to make sure that the accounting entries make sense. Eventually, you'll get the loan forgiveness confirmation from the bank, and the SBA will provide that to your bank. At that point in time, we're recommending that you go ahead and reduce your overall liability at that point in time, and you take that receivable off the book. So it's the other side of that entry. And then, of course, disclosure is key. I don't think there's going to be one way that everybody in the industry is going to be booking this transaction. So disclosing how you've done it to the people that are looking at your financial statements will be critical. So disclose. Make sure that it's clear what you did and how you did it. And we can help with some of those disclosures if you need us to. So that's the accounting entry. That's kind of the one component of it of how to enter that. If there's some more questions on that, please let me know. I don't know, Tom, if you're getting any questions, let me know on that. If not, we can come back to it later. So let's talk about the tax treatment. So we're assuming that you got the loan. We're assuming that it's all been forgiven. So now what happens with taxes? And we've heard a lot in the press that this is going to be, not taxable on the forgiveness side. But there's been some additional clarity that's come out. If you don't have to recognize the income, they don't want you to recognize the expense. So once again, what happens is this becomes a tax neutral transaction. So, as you look at this under the tax code here, and I won't read it completely to you, but let's just go through the transaction. Just like we just did, say $100,000 of PPP proceeds come in and get deposited in your bank. Debit cash, credit the liability. Say $100,000 is eligible for payroll expenses or the approved expenses. You debit the expense, credit cash. And then you still have that liability sitting on your books. The SBA and your bank say that you don't have to pay the money back, so you debit the liability and you're going to credit the debt cancellation of income. Now your tax people are going to have to figure out how to treat that. And what they're going to do is they're going to, on your books, they're going to put they're going to classify that cancellation of debt as non-taxable for federal purposes. And then they're also going to exclude the payroll expense that you use or qualified expenses that you use that money for. So $100,000 plus $100,000 minus, you become tax neutral. So, there's some legislative groups trying to fight this and saying they want to be able to take the expense, which would be certainly to the benefit of most of our clients, and that would be fantastic. But as it sits today, and I haven't read the news, and as we all know, this thing is a constant moving target. That's where it sits today. So just keep that in mind. There's some unintended consequences with this as well. So there's 21 states in the country that will automatically conform to whatever the federal statute says. The rest of them do not. So that means for federal purposes, this will be treated differently than states. So depending upon what states you're in, which I'm sure most of you are in multiple states, you need to make sure that those allocations are set up correctly. And you're not being overly burdened by having a disallowed expense, but needing to recognize the income. There needs to be, make sure that that's matched throughout the process. So that kind of takes you through the accounting and tax treatment component of this. I'm going to pause there and make sure that there's nobody that has any burning questions, or if Tom's getting any additional questions that you see.
Ears are burning. Yeah, perfect timing. I had one come through here, Mark, and the question is, I've heard from some of the accountants that the forgivable loan amount should flow directly through the equity in the balance sheet rather than the income statement. Is that not correct?
The short answer is no, that's not correct. We would put that through the P&L. That's the short answer. I would not treat it that way. You're taking, are they saying, does it read like a distribution as opposed to through the P&L? Tom, is that what they were saying? You said through the equity section.
So yeah, they through the through the equity in the balance sheet rather than the income statement.
Yeah, I mean, I'd love to see that guidance, but that is that's not the way we understand that. No.
Thank you, Mark. And that's all the questions I got now. I'll let you know if any additional or follow-up come through.
All right, well, good. Okay, so here's some additional guidance that came out. So I'm going to read through some of these slides. I'm going to talk about them from a high level. Some of the things I'm going to point out that I think are really important that came out through the application and the additional guidance on Friday. So feel free to jump in, and if I know the answer, I will tell you. But as we're going through this, as soon as I feel like I'm an expert, the rules change a little bit. So so bear with me with that. But this is the updated guidance that we just received. So they're really the 4 buckets of allowable expenses that can be forgiven. It's the payroll costs, and what goes in the payroll costs are salaries, commissions, similar compensation, cash or equivalents. So if I know I'm not going to get into that too much because we're all mortgage bankers here, but you could estimate what a typical tips would have been, and you could have paid that out and included it. So payments for vacation, parental, family, medical leave. So really these items that are associated with being an employee, those benefits are allowable to be forgiven. The maximum W-2 portion of that amount that you can take over that 8-week period of time is this $15,385. Now that's based on $100,000 divided by 52 weeks times 8 weeks. So that's a little different. If you have salary people that you pay twice a month, they might be making $16,000 and change over the 8 weeks. You're still limited to this maximum according to everything that I've read coming out of the SBA and the Treasury. So that's something to keep in mind. And when you go through the application, that's the maximum amount you can put on there. Interest on mortgage obligations, pretty self-explanatory. What I want to point out here is these are obligations that you had to have had as of February 15th, 2020. Same with rent. You didn't have to be in a space paying rent necessarily on February 15th, but you had to have the obligation. You had to have the rent contract signed and ready to go. Same with utilities, and the utilities include electricity, gas, water, transportation, telephone, internet, with services that began on February 15th. So remembering that day is important when you're going through these numbers to make sure that you are spending them in the right buckets. Not on the slide, but a matter of clarification. We were talking with a client who might not spend the money on all of these buckets. What we want to point out is it doesn't mean you can't spend it on other things. It just won't be forgiven. And any portion that's not forgiven is going to be due over 2 years at that 1% rate. So keep that in mind. 75% of the total forgiven cost must be paid to the payroll category. So bucket 1 needs to be 75%. The sum of the rest can be up to 25%. And of course, the number of full-time employees will be critical. So how you calculate that is also important. So some of that's
Hey,
reviews.
Mark.
Yeah.
Got a couple questions that came in pertaining to the last slide, kind of about the allocation for the PPP loan. First question is, and I believe it's related to payroll costs, but what about bonuses? A large number of our employees are paid on a salary plus monthly commission, and that was way before PPP came out.
Yeah, so you would take your average over the prior year and see what that looked like. And yes, you can pay that, but as long as it doesn't get above that maximum over the 8 weeks of the 15,385.
Okay. And then the secondary question from separate attendee, does the mortgage interest on investment properties qualify under any bucket?
Yes, it does under 2.
Okay.
Yep. Good.
Excellent. Thank you.
That's great questions. Okay, awesome. Okay, so this one was one that we didn't necessarily see coming. Some clients don't take, some of the owners of the business don't take out a whole lot in W-2. Some do. Some take more distributions. So this guidance came out. There is a cap of the amount of the forgiveness allowable to the owner, employee, or self-employed individual. So this one was a little bit of a different one that there was some clarification that came out. So I'm going to read it to you so I don't mess it up. But the amount of the loan forgiveness requested for owner, employees, and self-employed individuals payroll comp can be no more than the lesser, so it's the lesser of 852, so that's the 8 weeks of 2019. So your average comp over the prior year times 8 weeks, or 15,385 per individual of total across all businesses. So what this really means is that if you didn't pay yourself anything last year, and the PPP loan came in this year, and now you want to pay yourself based on the new loan, that may not be includable. That's what this says. Now, we'll see if there's going to be additional guidance on this, but that's something to consider. I think the vast majority of our clients pay themselves, at the owners, they pay themselves over $100,000 a year. If you did that, don't worry about it, you're fine. But if you didn't and you're trying to get up to that at least maximum amount and have it be forgiven, that might be an issue for you. So just keep that in mind. This does not include healthcare benefits. Those all be included throughout the year, but this is just for the compensation. So the timing of payroll. So the provision came out with a couple different things. So in general, payroll costs are paid and incurred in 8 consecutive weeks or 56 days covered period for to be eligible for the forgiveness. So that means that you are supposed to, as soon as you get the money in, the clock starts and you have 8 weeks to spend that money. Before I go further, I will point out that there is some movement on wanting to extend that 8-week period of time. That's mostly born out of companies who have got this money, but they haven't even been able to open their doors to pay their employees. So they feel like that is somewhat of an unfair, arbitrary rule, this 8 weeks. We're going to wait and see what they say. I personally hope that they extend it out to at least 10 or 12 weeks, but we'll see what happens. But for now, as my last look, it's still at 8 weeks. So the borrower may seek forgiveness for payroll costs up to 8 weeks, beginning either the day the disbursement of the borrower's PPP loan proceeds from the lender. Everybody on this call, by the way, when we say borrower, that's you, right? So as soon as you got the money, the clock starts, or so that's the first day, or you could say the first day of the payroll cycle in a covered period. So that's the alternative payroll covered period. So what happens is if you got if you got the funds and you distribute it and you're paying every other week, because the way that the 56 days lay out, you may have been penalized by the date that you received the funds. This is just the way, this is a way of the Treasury being flexible and saying, hey, listen, we know that that might be an issue. So we can have that date start with the new payroll cycle. So you're maximizing the amount of money that will be attributed to the forgiveness. So that's really what all this means. So, and you could read through the slides a little bit more, but that's really what this particular issue comes down to. So on the non-payroll costs eligible forgiveness, so non-payroll costs are eligible for forgiveness if it was paid during the cover period, so the cover period being what we just talked about, or incurred during the cover period and paid before the next regular billing date, even if the date is after the cover period. So once again, this is really an issue of accounts payable. We want to make sure that the expenses that you're being paid fall within this cover period. And once again, the Treasury is saying that they do not want you to be penalized just because you either got the money after a billing cycle or right before, which leaves out the full benefit of the 8-week period of time. This might all become a non-issue if they extend the dates out, but that's how this particular topic is working.
Hey, Mark, a couple questions that have come in directly along payroll scenarios.
Okay.
First of which is, if we received our PPP funds on May 1st and our payroll period starts April 28th, can that cycle be included, or can that payroll period be included?
May 1st and then April.
So they received the funds on May 1st, but the payroll period started April 28th.
That's quite a bit of time later. It's usually the, so are they paying monthly in that? That'd be unusual. The short answer is I think you can move it to the next payroll start cycle. So if the next payroll start cycle, if it's April 20th, I would imagine your next payroll start cycle would be April 1st through the.
No, it's April 28th. It was the payroll period. That's when it started, and they got the PPP May 1st. So it's just a few days.
Oh yeah.
Yeah. I thought maybe you didn't get that.
I was overthinking that.
Okay.
Sorry. Yeah. Sorry.
No worries.
That's why Casey's here. She'd keep me straight. But yeah, that's awesome. Yeah, you should be fine. The short answer is fine because it's either paid or in the cycle, but you have to pick one. So you're okay.
Excellent. And so appreciate that clarity. Another related payroll question. Our payroll looks like twice monthly on the 15th and 30th. We received our PPP funds April 30th. Therefore, our payroll period of June 15th doesn't fall within the 56 days. Does that then mean we can't include June 15th's payroll?
So once again, if you have to move the cycles to get the full 8 weeks. So if you line up your cycles, you should get that same benefit. And I know this is 56 days, but you can push that forward to the next cycles, what that alternative payroll period is. That's this provision. Let's see if I can bring it up here. Yeah, so the first day of the first payroll cycle is in the covered period. So that's the alternative payroll covered period. So that's under option 2. So under that scenario, it should work out.
Perfect. Thank you, Mark.
Yeah. Okay. All right. Oh, I went too far. Let's see. I think. Yep, we did timing of payroll, non-payroll costs. Okay. So reductions. This is the reduction of the loan forgiveness amount. The good news is originally you thought this was an all or nothing provision. It's not. So the good news when there's reductions means that you might have some of it that's not forgiven, but some of it will. So that's good news. But there's some calculations that go into it. So under the Act, it specifically requires certain reductions for the borrower's loan forgiveness amount based on reductions in full-time employees or in employees' salaries and wages during the cover period, subject to important statutory exemptions for borrowers who have tried to rehire employees and restored salaries to levels by June 30th. That's a mouthful. So what we're saying here is during the period in which you qualified for that you qualified for the loan, if you have less people working for you, then you might have a reduction in the amount of forgiveness. And if you pay them less, you might have a reduction of the forgiveness. And we'll go through each one of those scenarios. And the other part of that is even if you had let them go and you tried to hire them back, there's some additional exemptions that say that if you've tried to get them back and they didn't want to come back, that you won't be penalized. So that's good too. So, and we'll go through that. So let's calculate it. So in calculating loan forgiveness amount, the borrower may exclude any reduction of full-time equivalent employees headcount that is attributed to an individual if the following things occur. The borrower made a good faith written offer to rehire the employee. So you try to hire them, they said, no, don't want to come back. Or two, if the offer was the same salary or wage and the same number of hours as earned by such employee in the last pay period prior to separation of the reduction of hours. Under three, the offer was rejected by such employee. Number four, the borrower maintained records documenting the offer and its rejection. So in all these situations, what they're saying here is, you try to get somebody back. It didn't work out, but you made every effort you can. As long as you document that and include that into your application, you won't be penalized. So here's some more reductions in loan forgiveness. So the effective reductions of full-time equivalents, that's full-time employees, reduction in employees during the covered period or alternative payroll covered period reduces the loan forgiveness by the same percentage as the percentage reduction of the full-time employee. So you come up with the ratio of the reduction, and that's the amount that will be applied to the reduction of the forgiveness. The borrower must first select the reference period. So you have your reference period that you qualified, and these are the steps that you go through that. In the application itself, it kind of lays these out. So, and obviously we'll provide this deck to you, but it's how you calculate it. And it is somewhat complicated, admittedly, as you get into it. If the average number of full-time employees during the cover period or alternative payroll cover period is less than during the reference period, the total eligible expenses available forgiveness is reduced proportionally by the percentage reduction to the full-time employees. So I'm sure everybody just went to sleep on the call. I'm sure of it. But as you read through this, as you draw this out, you can be able to go through this calculation. The one thing I want to point out is in the original guidance, at least in the articles that were written about this, they were contemplating of allowing 30 hours equal full-time equivalent. That did not make it through the CARES Act. It's 40 hours. So keep that in mind. you are full-time equals 40 hours. So that's the measurement of full-time equivalence that's being used. Okay, moving right along. There's more ways it gets reduced. So in this scenario, what we're talking about here is if the salaries or compensation is reduced by 25% or more, then the total amount forgiven could be reduced, and could be the amount you forgive will not be as high as it would have been. So thinking about this for mortgage bankers, if you have your high producers, it's not going to make a difference because they're going to max out. But on your lower producers, it's something definitely to consider. If they may happen to have a good year, they're having a very average year, which would be remarkable given the current volume that's out there. But say that's happened, I would take a look at that and make sure that you don't have something that is going to surprise you and have a reduction because of this 25% rule. So, and if that does happen, you must reduce the total forgiveness amount by the total dollar amount of the salary or wage, reductions that are in excess of the 25% of the base salary wages between these dates. So just take a look at that, run the calculation and see where you end up. Most of it probably might not be a big deal for everybody on this call, but it's something to take a look at. And we can walk through these examples and you could read through them, but certainly an area to take a look at as you're seeing how you're going to end up at the end of the day with this forgiveness portion. How are we doing on time? Are we good? Yeah, good. Okay, so loan forgiveness. They have a process, and I've alluded to it, and I don't know if anybody on this call has actually looked at the application itself, but they want you to complete this 3508 it's an SBA form or something equivalent from your lender. The lender will review the application and make the decision regarding the loan forgiveness. The lender will have 60 days from receipt of the completed application to issue the decision. If the lender determines the borrower is entitled for forgiveness of some or all of the amount applied for, the lender must receive, the lender will ask the SBA for reimbursement and your loan will be forgiven. So the SBA will subject to review of the loan application, remit the appropriate forgiveness amounts to the lender, plus any interest incurred through the date of the payment. So in that 60 days, if it's forgiven, the interest accrued will be wiped out. So keep that in mind. One thing in here, the EIDL, if you receive the EIDL, any funds for that, there was a portion that was advanced on some of those loans, and that was converted to the grant. That grant, I think, was $10,000. If you receive that money, the forgiveness amount will be reduced by that $10,000. That's the way we read this. I think they're not talking about the portions that you have to pay back. So if you've got both the IDL and the PPP loan, the amount that was forgiven in the IDL will reduce the amount that is forgiven. So the SBA determines the course of review that the borrower was eligible for the PPP loan based on the provisions of the CARES Act, SBA rules, and other guidance available at the time of the borrower's application or in terms of the borrower's application. So for example, because the borrower lacked the adequate basis for the certification that is made in its PPP loan application, the loan will not be eligible for forgiveness. The lender will be responsible for notifying the borrower of the forgiveness amount. If only a portion of the loan is forgiven or the forgiveness request is denied, the remaining balance due on the loan must be repaid by the borrower on or before 2-year maturity, and it has that 1% accrual. So under this particular guidance, we did receive some calls from our clients concerned of how are they going to prove that we needed this loan. And there's a lot to talk about with that. Obviously, I'm sure most of the people on this call are hedging. They're delivering their loans on the mandatory basis. I think a lot of them had unprecedented margin calls, probably had some challenges in, not only loan margin, but in hedge losses. And we stand really ready to make that case if we have to for most of our clients. The other part, and in the Q&A, I'll talk a little bit more about a couple things. And there's one question in the Q&A that came out that some people, I'm sure a lot of people heard about, and it's this safe harbor amount that we can read through. But something definitely consider in this application. The application is a multi-page application that has schedules and attachments that go along with it, include payroll details. Let me touch on the frequently asked question. This is the question I was alluding to that came out on May 13th, question 46. It said, how will the SBA review borrowers' required good faith certification concerning the necessity of their loan request? This is something we touched on already. It says submitting the PPP loan application, borrowers must certify in good faith that the current economic uncertainty makes the loan request necessary to support ongoing operations of the applicant. SBA, in consultation with the Department of Treasury, has determined that the following safe harbor will apply to SBA review of the PPP loans with respect to the issue. Any borrower that together with its affiliates received the PPP loan with an original principal amount of less than $2 million will be deemed to have made the required certification concerning the necessity of the loan request in good faith. So if you received less than $2 million, the way we read this is there shouldn't be we don't anticipate any follow-up based on this. It goes on to say, the SBA has determined that this safe harbor is appropriate because borrowers with loans below this threshold are generally less likely to have access to adequate sources of liquidity in the current economic environment than a borrower that obtain larger loans. This safe harbor will also promote economic clarity as PPP borrowers with more limited resources endeavor to retain and rehire employees. In addition, given the large volume of PPP loans, this approach will enable the SBA to conserve its audit resources and focus in reviews on larger loans where the compliance effort may yield higher returns. So to keep that in mind, they definitely will. They have an audit component of this that will be going out and looking at these loans. Importantly, borrowers with loans greater than $2 million that do not satisfy the safe harbor may still have an adequate basis for making the required good faith certification based on the individual circumstances in light of the language of the certification and SBA guidance. SBA has previously stated that all PPP loans in the final rule in the borrower's application form. So without going further into it, it's an important part of this. And as you go into the application process, this is a good little thing to have. In addition, there was a rule, there was some arguments that mortgage bankers in particular did not qualify based on some SBA rules as it relates to being a lender and servicing loans. The MBA did a good job of trying to attack that issue, and they put out some pretty decent guidance that I did not put in my slides. But if the intention is to sell your loans in 14 days, there's some provisions in there that say that is not applicable. And I think the spirit of what was put out was to support businesses like all of ours here on the call. So that seems to, we've been past that part, but If you get that from your lender, please reach out and we can provide some additional clarity and help with that issue if it does happen to come up. Some potential changes that are coming out. They're talking about extending the 8-week period to pay it, to spend the money on the qualified expenses. They're talking about that. There's another stimulus bill that's going through Congress for individuals and business, payroll tax holidays for employers. And then business owners are capped at the amount of 2019 employee cash compensation, employer retirement health. So just keep it there. This still is there's still a lot coming out. Some of it, I think it's going to quiet down on any real changes for the PPP. I would anticipate there being, I think they are going to extend the 8 weeks, but I don't know. Of course, you can't hold me to that, but they might only do that for particular industries. And if they do, I would imagine if they exclude some, our industry here, the mortgage banking industry, will be excluded. So, and I think with that, are there any additional questions? I don't know. I think I'm towards, I'm at the end. Yes.
So Mark, let me thank you first and foremost for going through all that. And just a quick reminder to our attendees, like we've got about 4 minutes here. So any questions that you've got, please feel free to filter those to the chat or Q&A functions as you've done throughout the call. And we've got a quick open forum to be able to present those out to Mark and Casey. Mark, I've got one here in the chat box, a bit of a scenario question related to ensuring that there's no other provisions for the organization. Comment question goes, we're a company that grew a lot in 2019, especially in the second half of the year with regards to headcount. We select 2019 as a base year for full-time employee reduction comparison. Although we let a lot of employees go in 2020, i.e. March and April, we feel we would be all right. That scenario being laid out, just wanting to make sure from your perspective that there would be no other provision.
Well, I would want more information. They were growing in 2019. If they were there, if that was a full year and that's the base year, then they might have some challenges with that. So, I mean, that's something that we have to look at. That it would need to be looked at closely, because the reduction of FTE is part of the calculation.
Gotcha. Another question I had, is there any key differences or considerations in PPP guidance on how a company should log payroll for forgiveness of the proceeds between W-2 or 1099 employees?
Yes, 1099s are not included.
Excellent. And just a reminder, last call for any questions out there from our attendees. I think you kind of covered this, Mark, but any key differences for part-time staff on, either logging their wages or for PPP payroll considerations?
No, so your part-time people will accumulate, and as they get to, if you have 2 part-time people working 20 hours a week, together they equal 1 FTE. So it goes into the calculation on qualifying for the number of FTEs. And keep in mind that the amount that you're paying for them is a separate calculation on the forgiveness. The amount of hours they're working goes into determining if you've had if you've shrunk your overall employee base or you've increased it or kept it the same. So the calculation on the FTE is really related to the number of hours or salary hours that they've worked. Did I answer that question? I hope I did, but yeah.
No, that answered it well. I appreciate that. And actually, at this point, I don't have any additional questions. For the attendees, if you have any questions, we will provide Mark and Casey's information as part of our follow-up, as well as you can direct any questions for Mark or Casey to our team here at TMC. And on that note, I do want to thank Mark and Casey again for taking the time out to lead today's discussion. And it sounds like with some potential updates and changes that may be out there, we may need to bring you back, Mark, some point in the near future to revisit the PPP discussion.
Yeah, I'd be happy to do that or talk through any of the other issues that exist out there. We're really happy to be part of the collaborative. You guys do an amazing job keeping everybody informed, and we're happy to be a part of it. So thanks for including us.
Well, thank you so much for being a part of TMC, and thanks for everybody for joining today. Not lost on us how frantic, how busy everybody is. So on that note, hope we all stay well, stay sane, and enjoy the rest of your day.
All right. Thank you so much.
Take care. Thank you.